Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional.
Hello. Good to be discussing this one.
Yeah, definitely. Today we're really diving into Texas Instruments' first quarter 2025 earnings call. We've got the corrected transcript right here.
hmm
And what we want to do is, unpack what it tells us about their performance, what they're seeing out there in the market.
Which is always
Yeah,
interesting.
exactly, and how they're thinking about the future, especially with, well, everything going on globally.
For sure. We'll break down the revenue piece, look at the different sectors, talk about their view on the semiconductor cycle, which is always crucial, and those geopolitical factors too.
Right. And then, of course, the financials, their guidance. The aim here is really to give you, the listener, a clear picture of the most impactful takeaways from this call.
Sounds good.
Okay, so first things first. To understand where they might be going, we need to look at Q1 2025 performance. Where did they land?
Well, the headline number was overall revenue of $4.1 billion.
Okay.
That represents a 2% sequential increase, so up from Q4, and an 11% increase compared to the same quarter last year, so decent year-over-year growth.
Got it. And how did that break down across their main business areas?
Yeah, good question. Analog revenue saw pretty strong growth, up 13% year-over-year.
13%, okay.
Embedded processing, on the other hand, was basically flat compared to the previous quarter.
Slant sequentially.
And then their other segment actually had a really big jump, 23% year-over-year growth there.
Wow, okay. So quite varied performance across the segments. What about the end markets? Who's actually buying this stuff right now? How'd that look sequentially?
This is where it gets quite interesting, I think. The industrial market showed upper single digits growth sequentially.
Upper single digits. Now, wasn't industrial declining for a while?
Exactly. That's the key point. This growth comes after 7 straight quarters of decline.
7 quarters. Okay, so that feels significant.
It really does. They mention it seemed like a broad recovery across different industrial sectors and even different geographies. It might signal something bigger.
Yeah, potentially a turning point after a long slump. What about automotive? That's been a strong area generally.
Automotive saw some growth, but more modest, low single digits sequentially.
Okay, still growing, but not like industrials rebound.
Right. Then you had personal electronics, which, well, it declined mid-teens.
But that's often seasonal for Q1, isn't it?
Typically, yes, so likely expected. Enterprise systems grew mid-single digits, and communications equipment was up around 10% sequentially.
Okay, quite a mix there, but that industrial turnaround really stands out.
It does,
Yeah.
and underpinning some of this, they stated a belief that customer inventories are generally low across, well, pretty much all end markets.
Ah, okay. So customers might be ordering more just to restock, not necessarily just final demand increasing, or maybe both.
Could be a bit of both. Low inventory certainly helps explain some of the current strength, especially if they think we're near the cycle bottom.
Right. Which brings us to the broader environment. How are they navigating all this? Uncertainty, tariffs, geopolitics, supply chains. It's a lot.
They definitely acknowledged the high level of uncertainty. It came up multiple times. They
Yeah.
talked about viewing the current situation through kind of 2 main lenses.
Like-
First, where are we in the semiconductor cycle? They believe we're likely at or near the bottom.
Consistent with the low inventory point.
Exactly. And second, the increasing importance of what they call geopolitically dependable capacity.
Geopolitically dependable capacity. Can you unpack that a bit? What does that mean in practice?
Essentially, it's about having manufacturing and supply chains that customers can rely on, even amidst international tensions or trade disputes. Think, diverse manufacturing locations, maybe more localized supply for certain regions.
It's becoming a selling point. You can count on us even if things get messy globally.
Precisely. They see this as increasingly critical and valuable for customers who are, understandably, worried about supply chain disruptions. They really emphasize their own flexibility and how they're prepared to adapt.
Okay, that makes sense. Having capacity ready, especially if inventories are low and the cycle is turning, plus being seen as a reliable supplier geopolitically. That sounds like their strategy.
That seems to be the core message, yes. They mention their 3 key ambitions: acting like owners, adapting and succeeding, and being a company people are proud of. This all feeds into that.
Got it. So how does all this uncertainty and their strategy translate into their outlook for the next quarter, Q2 2025?
Well, their guidance seemed, I'd say, cautious. They highlighted the ongoing changes and the need to really understand and support what their customers need right now.
So even with the industrial rebound, They're not getting overly optimistic just yet.
It seems not. They explicitly said the potential impact of everything tariffs, geopolitics on customers, suppliers, and themselves is still unclear. It's a situation that's likely to keep evolving.
Did they see any immediate impacts from, say, tariffs hitting the Q2 numbers?
They said no, not for the second quarter guidance. No immediate near-term impact anticipated based on what they see right now.
Okay, so what are the actual numbers they guided for Q2?
Revenue is expected between $4.17 billion and $4.53 billion.
Okay, so the midpoint is slightly higher than Q1's actual revenue.
Correct. And earnings per share guidance is $1.21 to $1.47.
Right. But beyond Q2, looking into the second half of 25 or even 26?
There, they expressed quite a bit of uncertainty. They basically said they're prepared for different outcomes and need to stay flexible. No firm predictions further out.
Understandable. Okay, let's shift over to the financial details from Q1 and how they're managing capital. What did the profit picture look like?
Gross profit was $2.3 billion. That works out to 57% of revenue.
57%. How does that compare?
It was actually down slightly sequentially, about 90 basis points on the margin.
Okay, bit of pressure there. What about operating expenses?
OPEX came in at $989 million. That's up 6% compared to last year, but they said it was roughly in line with what they expected.
Got it. So operating profit.
$1.3 billion, which is 33% of revenue. And that number was actually up 3% year over year.
Okay. And the bottom line? Net income.
$1.2 billion, or 1.28 per share. And they noted that included a small 0.05 benefit that wasn't in their original forecast.
All right. How about cash flow? Always important.
Cash flow from operations was $849 million for the quarter. Looking back over the last 12 months, it's $6.2 billion.
That's substantial. And investments, capital expenditure.
They spent $1.1 billion on CapEx in Q1. Over the last 12 months, that totals $4.7 billion. They are definitely investing heavily in manufacturing capacity.
Right, that fits with their strategy. So free cash flow after those investments.
Trailing 12 months free cash flow comes out to $1.7 billion.
Okay. And what are they doing with that cash, returning it to shareholders?
Very much so. They paid out $1.2 billion in dividends just in Q1 and repurchased $653 million worth of their stock. So over the past year, the total capital return to owners adds up to $6.4 billion.
$6.4 billion returned in 12 months. That's significant. How does the balance sheet look overall? Debt levels.
Pretty strong. They ended the quarter with $5 billion in cash and short-term investments.
Okay.
They also paid down $750 million of debt during the quarter.
Oh, okay. So deleveraging a bit.
Yep. Their total debt now stands at $12.95 billion, and the weighted average interest rate on that is just under 4%, 3.93%.
Seems manageable. What about their own inventory levels? You mentioned customer inventory was low.
Right. TI's own inventory actually increased slightly, up $160 million sequentially to $4.7 billion.
Oh.
That represents about 240 days of inventory.
240 days. That seems
Yeah.
high. Or is that part of the strategy to have product ready?
It is relatively high historically,
Yeah.
but it likely ties into their strategy of having capacity and inventory available, especially if they believe the cycle is turning and want to ensure that dependable supply. They do expect factory loadings to increase slightly in Q2, though.
Okay, that makes sense in context. Any other financial tidbits? Tax rate.
Yeah, for Q2, they expect an effective tax rate between 12% and 13%. And overall, the message was continued focus on long-term value, investing in those competitive advantages, manufacturing, broad portfolio, channel reach, and disciplined capital allocation.
Got it. Now, the Q&A sessions on these calls are often very revealing. Were there any particular themes that stood out? You mentioned tariffs earlier.
Yes, tariffs were definitely a hot topic. The main takeaway was still uncertainty. They emphasized working with customers, highlighting that geopolitically dependable capacity, supply chain flexibility. But they couldn't point to a specific, quantifiable impact purely from tariffs in Q1 or in the Q2 guide.
And customers aren't explicitly saying, we need to order now because of tariffs.
Apparently not as the primary driver, no. It seems the low inventory and cycle dynamics are more dominant factors right now, based on the commentary.
Okay, inventory came up again in Q&A.
It did. Reiteration that customer levels are low, potentially driving demand. Confirmation that TI's own inventory ticked up slightly, but they expect factory loadings to increase a bit in Q2, suggesting they plan to utilize or perhaps slowly draw down some of that inventory build.
And the market strength, specifically that industrial recovery.
Yes, highlighted again as a major driver, broad strength across sectors and geographies. Automotive growth was described as, I think the word used was shallow, but still present.
Shallow, okay. What about China? Always a key market and area of focus.
Absolutely. They stress China remains very important long-term relationships there. Again, they framed their offering in terms of providing that dependable capacity, using their global manufacturing footprint and inventory to serve customers in China and global customers with operations in China.
But what about competition there? We hear a lot about local Chinese competitors ramping up.
They acknowledged competition is intensifying, definitely, both through general-purpose chips and more application-specific ones.
So how do they compete?
They believe their advantages lie in their scale, the breadth of their product portfolio, quality, and importantly, that reliable supply and dependable capacity message.
That flexibility theme again.
Yeah.
Did they elaborate on the manufacturing flexibility?
They did. They talked about having both internal manufacturing and using external foundries that dual flow. This lets them shift production around, optimize logistics based on, geopolitical shifts or customer needs. And interestingly, they noted that the front-end part, making the wafers, and the back-end part, assembling and testing, don't have to happen in the same place. That gives them significant flexibility to manage supply chains.
That's a really interesting operational detail with strategic implications. Was there a discussion on whether the current growth is coming from higher prices due to tariffs or just more volume?
Yeah, that was asked directly. They attributed the current growth to increased volume per customer, linked to the cycle recovery, explicitly stating it wasn't due to price increases tied to tariffs.
Okay, volume-driven recovery. And lastly, any more on capital allocation philosophy?
Just reinforcing the main goal. Return free cash flow to owners via dividends and buybacks, while balancing that with the necessary strategic investments, particularly in CapEx right now. They feel comfortable with their cash position and noted they could take on more debt if needed, if it made strategic sense.
All right, so wrapping this all up, what are the sort of one or two main things we should take away from this TI call?
Well, I think first, the signs point towards the semiconductor cycle being in a recovery phase, maybe early stages. But the industrial sector bounce back is pretty compelling evidence.
Yeah, that seems key.
Second, the geopolitical uncertainty and tariff situation are definitely real factors, but the immediate direct impact seems, well, still being assessed. It's more about strategic positioning right now.
And TI's response is emphasizing that flexibility, that dependable capacity.
Exactly. They're leaning hard on their manufacturing adaptability and supply chain management as a way to navigate these challenges while sticking to their long-term growth and shareholder return plans.
It really makes you think. So maybe a final thought for our listeners. Considering this global landscape, this economic and political complexity, how might companies like TI really leverage this supply chain flexibility, not just to dodge immediate problems, but maybe as a core long-term competitive advantage? Building resilience into the business model in a world that seems like it's only getting more complex.
It's a great question. It's probably something many companies, especially in critical sectors like semiconductors, are grappling with right now, how to turn that flexibility from a reactive measure into a proactive strategic strength.
Definitely something to ponder.
Mm-hmm.
Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.